What if I told you there are still cheap stocks out there in 2026 with massive upside? Sounds crazy, right? Everyone thinks the market's expensive, that all the good deals are gone. But today I'm showing you 6 stocks that the market has completely overlooked. We've got an on-site power generation play, solving AI biggest bottleneck, a dominant edtech company still priced like a mid-cap despite insane margins, a nuclear energy name positioned for the AI power crunch, a defense stock that most investors have never even heard of, and a gambling/sports data business quietly printing cash while trading at a fraction of its peers. Every single one of these fits a simple criteria: strong growth, low valuation, and a catalyst most people are sleeping on. The first stock on the list is growing a similar business as the stock I covered 2 weeks ago, which is called AROC. AROC is already up more than 60% since that video. These stocks are both in the on-site power generation industry, which is now solving the biggest bottleneck for AI, and that is power. The stock is called FTAI Aviation. FTAI found a clever second life for old jet engines, converting them into power generators for things like data centers, which are hungry for electricity. This new power business launched at the end of 2025, and it already landed a massive $1.465 billion purchase order for gas turbine generator sets through its joint venture. This demand and growth is visible in their numbers. They are forecasting to grow their revenues 50% and their EPS 40% the coming year. And 17 days ago, an insider bought $500,000 worth of stock, which is a bullish signal. Their original business takes old popular airplane engines and turns them into a money printing machine by fixing them, selling spare parts for them, and now even turning them into power generators. The engines it focuses on power thousands of Boeing and Airbus planes. These planes aren't going away anytime soon, so demand for engine repairs isn't either. FTAI has an exclusive deal with a parts maker called Chromaloy that lets it use FAA approved replacement parts at a fraction of the normal cost, saving up to $2 million per engine overhaul compared to competitors. This gives FTAI unusually fat profit margins. It's already near 35%, with room to grow toward 50%. Money that's very hard for rivals to match because they don't have the same parts deal. Instead of buying every plane and engine itself, FTAI raises money from outside investors through something called its Strategic Capital Initiative, letting FTAI manage and service planes it doesn't even have to fully own. This means faster growth without piling on debt. This asset management arm could reach $8 billion in assets under management by 2028, generating steady, recurring management fees on top of the repair business. Here's what I'm forecasting for the stock. Pretty stable and significant growth for the coming years, which would provide you with around a 150% upside by the end of 2028. This is based off the company their own guidance and analyst numbers. If you want access to the upside potentials of all the stocks I track and own, make sure to join the Discord, and over there you will find the link for the Mr. Invest sheet. Next up, we have a previously much loved software stock, which is now cut in half for no good reason. The stock is called AppLovin. After the sharp share price decline, the stock trades at a forward PE ratio of around 18 times, and for a company growing revenue 50% plus, that's remarkably cheap. The company guided Q3 revenue of roughly $2.08 billion, so growth isn't stopping. AppLovin is basically an AI matchmaker for advertising. Its AI engine, called Axon, figures out exactly which ad to show to which person to make them buy or download something. It started in mobile gaming ads, where it completely dominates, and is now expanding into the much bigger world of online shopping ads. Think of it as a money printing machine. Advertisers put in $1, get more than $1 back, and keep coming back for more, with margins expanding to 84%, meaning for every euro of revenue, 84 cents becomes operating profit. The net profit margin over the trailing 12 months sits above 60%. Even Apple and Google can't touch that. Why? It's pure software. No factories, no warehouses, no delivery trucks, just an AI algorithm running in the cloud. The company bought back 1.14 million of its own shares for $551 million during Q2 alone. They think the stock is cheap. No dilution games here. The share count is shrinking, meaning your slice of the pie gets bigger over time. Here's what I'm forecasting for this stock. With at least 20% revenue growth for the coming years, that gives you an insane return of 200% by the end of 2028. For an A-tier software company, the valuation it's trading at is never heard of. Next up, we got a data center stock that just signed a tenant and is significantly undervalued. The stock is called Fermi. Fermi builds private power campuses for AI customers in the United States. Think of it as building its own power city that doesn't depend on the public electricity grid. Their flagship project is called Project Matador in Texas. The ambition is a 17 gigawatt next generation private grid, one of the largest in the world. The simple pitch: AI data centers are desperate for power, the public grid can't keep up, and Fermi sells the solution. Electricity delivered directly on site, no waiting years for grid connections. Fermi signed a 15-year binding lease with TensorWave, its first anchor customer, covering 222 megawatts of facility power, worth approximately $6.5 billion in total contract revenue. The deal also includes 2 expansion options for TensorWave to triple the size of its footprint on the site over time, up to 650 megawatts of power. The biggest doubt around Fermi was always, will anyone actually sign? That question is now answered, and one anchor tenant usually attracts the next ones. Management confirmed on the earnings call that hyperscalers have been attracted to engage with Fermi, and those conversations are moving forward. First revenue from TensorWave is expected to start phasing in late Q3 or early Q4 2027, so there's now a visible countdown to real money coming in. Before we head over to the next stock, one more thing about the Discord community. I share a ton of important information every single day, such as what I'm buying and selling, if there are insiders buying stocks, when companies announce share buyback programs, which stocks Congress is buying, and the 10 most important daily market headlines. Next up, we got a stock that is ready to benefit a ton from Europe defense spending, and the stock is called Steyr Motors. The stock dropped around 20% today after the company warned for a delay in revenues due to bureaucratic approvals delays and permitting delays. The company scrapped its ambitious 2027 outlook, but management insists underlying demand is intact, and deliveries are simply shifting 1 to 2 years later. Steyr Motors is an Austrian company that builds high-performance diesel engines for heavy-duty vehicles and boats. Think military vehicles, patrol boats, and generators. Their engines are used in mission-critical situations, meaning if the engine fails, lives are at risk. That's why customers pay premium prices and don't switch suppliers easily. The company is listed on the stock exchange since October 2024, so it's still a fresh under-the-radar name that most investors haven't discovered yet. The total order backlog stands at 308 million euros, of which roughly 200 million is legally binding. Put that in perspective, the backlog is more than 6 times last year's entire revenue. This gives the company exceptionally high sales visibility until the end of 2030, meaning the growth is not a hope or a dream, the orders are already signed. On top of that, management sees opportunities with a total potential volume of more than 500 million euros. Extra deals that aren't even in the numbers yet. Europe is rearming at a historic pace and Steyr sits right in the middle of it. They signed a new long-term framework agreement with KNDS until 2034 for at least 500 motor generator units. KNDS is the maker of the Leopard tank. They also have framework agreements with partners such as Rheinmetall Land Systems and Laborde Products. These are the biggest names in European defense. More growth is coming from new European defense programs and ongoing tenders totaling nearly 2,000 vehicles across several countries. One of the hottest themes in modern warfare, unmanned surface vehicles or drone boats. Rising demand in the defense marine sector, particularly for unmanned surface vehicles, forms the basis for significant growth acceleration. These USVs operate without a crew, remotely or autonomously, and are used for reconnaissance, surveillance, patrols, and mine detection. Exactly what we've seen change naval warfare in Ukraine. The company is also expanding into the USV market and mobile energy solutions, 2 brand new revenue streams. Their newly developed M12 power unit is being tested by European armed forces and a renowned drone manufacturer. If that turns into series orders, it's a whole new growth leg from 2027. They acquired 100% of the Danish companies BUKHAS, and this deal is developing more profitably than originally expected, opening additional potential in the international defense and specialty boat market. And here's what I'm forecasting for this stock. With revenue growth picking up in 2027 and 2028, the stock has the potential to give you a return of 200% by the end of 2028. Next up, we got a similar stock as Genie Sports, the stock I mentioned in this video, that is now up 30% because of their large moat and decent growth. The stock Grandstand has a similar moat and business and is priced like a dead stock. The stock is trading at a price to sales ratio of 0.5, while they are forecasting an EPS growth of a 160% over the coming 12 months because they just finished their business transition. The company calls itself an intelligence layer for sports, gaming, and entertainment, meaning it's moving from being just a gambling ad company to owning data, tech, content, and fintech across the whole industry. Sports data services revenue rose 12% year over year. Enterprise clients now make up the majority of sports data revenue. This data business is becoming the company's real mode. Rollcard is the company's first move into consumer fintech, targeting sports betting and gaming users. Management pegs it as a $50 to $100 million revenue opportunity over 5 years, but at a market cap of roughly $66 to $80 million on $165 million in expected 2020 2026 revenue, the market is pricing this almost like a company in decline, not one that just diversified into AI-powered data, fintech, and enterprise contracts. And here is what I'm forecasting for this stock. With revenue growth only around 8% for the coming years, the stock still has the potential to give you a return of more than 200% by the end of 2028, all because of their switch to decent profitability. Next up, we got a stock that will solve the power problem for the AI revolution, and it's called Deep Fission. Most nuclear companies build big, expensive plants above ground. Deep Fission does something nobody else does. It places a small modular, pressurized water reactor in a borehole approximately 1 mile underground. Here's the clever part. They combine proven, established reactor technology with a novel underground deployment model designed to simplify construction, improve safety, and support scale. So the reactor itself isn't experimental, only the way it's installed is new. Think of it this way. A mile of solid rock acts as a natural containment building. That means no massive concrete dome, which is one of the biggest costs of traditional nuclear plants. This is the headline number. The company has signed letters of intent with data centers, co-developers, industrial parks, and strategic partners representing up to 18.5 gigawatts of potential generation capacity. To put 18.5 gigawatts in perspective, that's roughly the output of 15 plus large traditional nuclear plants. For a company worth about $500 million, that pipeline is enormous. Deep Fission was selected for the Department of Energy's reactor pilot program, meaning the US government literally picked them as one of the companies to fast track. The DOE approved the company's nuclear safety design agreement for the gravity reactor by the key regulatory milestone that sets the safety framework and lets them advance toward demonstration. Regulation is the biggest hurdle in nuclear, and they just cleared an important one. The company targets first commercial operations in 2027 to 2028. In nuclear terms, that's lightning fast. Traditional plants take 10 plus years, and with enough patience, this stock could give you a return of over 400% by the end of 2030. But that won't happen without major ups and downs. But if I gave you some insight in new and interesting stocks, make sure to smash the like button. I would really appreciate that, and make sure to join the Discord community where I share a ton of important information every single day. So I will be happy to have you in our community.